The biotech sector faces persistent challenges that may signal trouble for the broader economy. Earlier optimism about post-election momentum clashes with the reality of continued weakness and underperformance. Extended price declines, subdued investor sentiment, rising interest rates, and market volatility all converge to intensify the biotech sector's struggles. M&A activity drives innovation, fuels growth, and helps pharmaceutical companies fill critical pipeline gaps. Deal volumes in 2024 fell short of historical levels despite some large acquisitions. IPO struggles, secondary offering challenges, and smaller deal sizes reflect heightened investor selectivity. The outlook for 2025 requires a more cautious perspective. The probability for a positive 2025 outcome has been revised downward from previous expectations. The recommended investment strategy emphasizes large cap and mid cap focus, while being highly selective with small cap opportunities. Periodic volatility may create attractive entry points for quality companies with strong science and execution-focused management. The Biotech Capital Compass combines navigation imagery with scientific elements to guide investors through the sector. This newsletter serves active investors, traders, and biotech enthusiasts seeking actionable market insights. Hartaj Singh brings 30 years of experience spanning drug development, corporate strategy, and hedge fund management. It's time to test whether the newsletter's earlier predictions hold up. The October hypothesis of post-election momentum contradicts the actual performance of continued weakness. Analyzing the NBI index over 20 years reveals that extended weakness periods, while concerning, are not uncommon. From October 2024 to January 2025, the NBI index declined 6.65%, while the S&P 500 gained 7.56%, highlighting biotech's significant underperformance. The sector showed weakness in early October, appeared to stabilize in early December, then closed 2024 with 4 consecutive months of negative performance. The 2005, 2008, 2011, and 2021 downturns each represent extended periods when biotech struggled. This heat map reveals monthly performance patterns from 2005 to 2023, with green showing gains and red indicating losses across different years. Biotech sector weakness often serves as an early warning for broader market trouble. Prolonged biotech declines have historically preceded market downturns in 2008, 2011, 2015, and 2018. The chart shows biotech weakness, marked by red ovals, consistently appearing before broader market declines over the past 20 years. The authors remain skeptical that strong biotech performance necessarily signals broader market strength. Stock market weakness, industry layoffs, and sluggish M&A activity all feed into increasingly negative sentiment. Let's examine what investors and professionals are actually saying about the sector. Stock reacted negatively. What are investors missing? The Fed decision has more impact on our sector than sometimes some of the science that we do. Biotech is more like a smoldering underground coal fire that nobody can put out. Interest rates and biotech share prices share a complex, inverse relationship. Rising interest rates bring higher borrowing costs, reduce speculative investment, and lower valuations for biotech firms. External funding reliance, long profitability timelines, and high discount rates all pressure biotech valuations. Rising rates push investors toward utilities and consumer staples, away from riskier biotech stocks. Biotech share prices typically move in the opposite direction of interest rate policy. The chart shows biotech performance declining when treasury yields rise, and vice versa, from January 2023 to January 2025. Low or falling interest rates create favorable conditions for biotech. Low interest rates enable easier funding access, boost risk appetite, and increase M&A activity. Low rates make it easier for biotech companies to secure capital for R&D and operations, enhancing growth potential. Some factors can cause biotech to move independently of interest rate trends. Innovation cycles can sometimes override interest rate trends, though this requires truly extraordinary breakthroughs. Large-cap biotech companies with established revenue are less sensitive to rising rates than smaller pre-revenue firms. Market volatility also affects biotech performance, though not as strongly as interest rates. Investor risk aversion, funding uncertainty, and IPO challenges all contribute to biotech performance decline during volatile periods. Market volatility makes funding harder, potentially delaying clinical trials and product development. Volatility leads to IPO delays, reduced valuations, and equity offering challenges. Increased volatility triggers what market participants call a buyer strike, as investors retreat to wait out the turbulence. The chart shows how volatility spikes in the VIX tend to coincide with declines in biotech share prices. Volatility amplifies the price swings already common in biotech stocks. Biotech stocks swing on clinical trial outcomes, regulatory decisions, and M&A activity. Volatility makes these moves even bigger. Biotech stocks exhibit higher beta than the market average, meaning they experience exaggerated price changes. Volatility isn't always negative. It can create opportunities. Increased volatility creates acquisition opportunities for cash-rich pharmaceutical and biotech companies. Volatility attracts speculative traders seeking short-term price movements and trading opportunities. Short-term volatility impact differs from long-term fundamentals in determining biotech performance. Volatility periods can provide attractive buying opportunities for patient, long-term investors. Biotech IPOs and secondary offerings face significant challenges in 2024. Deal activity showed recovery in number, but total dollar values remain subdued. Market volatility, interest rate pressures, and cautious sentiment all made IPOs challenging in 2024. The dashboard shows that while deal counts increased in 2024, overall value stayed lower, and most offerings lost value after pricing. Deal activity in 2024 showed recovery from the 2022 lows, though conditions remain challenging. Transaction sizes in 2024 were smaller than historical norms. Secondary offerings came from established companies with clinical progress and commercialization success. Despite more deals getting done, post-offering performance remained generally negative. The 2024 market demanded investor selectivity, robust value propositions, and de-risked pipeline. M&A plays a critical role in driving biotech innovation and growth. M&A accelerates innovation, provides technology access, and enhances pharmaceutical pipelines. Small biotech firms rely on M&A as an exit strategy to access capital and advance their innovations. Biotech R&D involves high costs, long timelines, and high failure rates. M&A helps share these risks. Large biopharma companies use acquisitions to fill pipeline gaps and replace revenue from expiring patents. Acquirers leverage their resources, expertise, and infrastructure to bring products to market more efficiently. M&A enables companies to enter new therapeutic areas, geographic markets, and patient populations. The dashboard shows M&A volume peaked in 2021 and has declined since, with 2024 showing mixed results. M&A activity signals confidence in biotech and validates innovation. M&A validates sector confidence, innovation value, and drives investor interest. A robust M&A environment attracts funding, fosters innovation, and energizes the entire biotech ecosystem. M&A provides essential liquidity events for venture capitalists to realize returns and reinvest. The newsletter is shifting to a more cautious outlook for 2025. Share price weakness, low investor participation, and reduced strategic activity all point toward a more cautious view. As a risk-on sector, biotech's extended challenges may signal broader economic weakness ahead. The probability for improved 2025 performance has been revised significantly downward from earlier estimates. Weak sentiment, rising interest rates, and market volatility are shifting the sector's dynamics. The recommended allocation is 50% large cap, 30% mid cap, and 20% small cap. Long-term investing requires patience, discipline, profit-taking when available, and alertness for opportunities in quality companies. The newsletter remains committed to providing valuable insights into the biotech sector, helping readers navigate challenges, capitalize on opportunities, and minimize